Our next panel is on the global trends in tech lending and lessons for India. The speakers today in our panel are Mr. Milan Dolansky. He is head of online at Home Credit India. Mr. Artem Andreev. He is the country manager India for Think Friends, and he represents Digital Finance International. Mrs. Ilica Chauhan. She's vice president, PC Financial Services. All of them are actively involved in digital lending in India, the international players of digital lending in India. Our moderator for this panel is Anuroop Omkar, partner at AKN Partners. Anuroop, over to you.
Thank you, Kritika. In the interest of people you are attending, experience of, I think, all the three panelists put here will be possibly 50 to 60 countries, because Home Credit is present in more than 30 countries in the world. Digital finance is present in more than 10 countries, and so is Opera Group, or rather, let's put it PC Financial. And PC Financial is touted to be one of the fastest growing digital lending company in India. So welcome to all the panelists here for the first session. So how I have designed it is I have specific questions based on your experiences and your profiles to be put forward. But any of the attendees who wish to put forward their questions can type it in the chat box. Towards the end of the session, if you are left with some time, the specific question can be directed to the specific panelist and can be answered. So beginning with Artem, you guys have been into the lending space for last 25 years, which is like the Finstar, the digital finance in India, what you call Think Friends and Rupee Ready. So you have been across nations. As far as my knowledge goes, you have been handling Sri Lanka, you are handling India, you are handling Vietnam, you are possibly handling Russia. So we are, I'm very excited to get a lot of knowledge from your end in terms of what India should learn, because those nations have traveled a certain distance when it comes to the digital lending space, which is relatively new in India. I won't say in very nascent stage, but relatively new in India. So the very first question to you, Artem, is what we understand before working in the digital lending space, you were working in the product management relating to personal loans and credit cards. What do you think is the difference between regulating a brick and mortar finance company vis-a-vis a fintech company? And to be more specific, especially in the context of those specializing in unsecured loans, as Mr. Palibal just pointed out, the lending in the digital space starts from 1,000 rupees and can go till 1 lakh or even more than that. So most of it is understood to be unsecured lending. So this is the first question for you, Artem. So if you could just educate all of us on that.
Hi, colleagues. Nice to see you, to hear you. It was a very nice start of discussion. Let me try to provide somehow my view based on my experience, based on the markets I participated in, and try to explain my logic, let's say, right? So like you ask, what's the difference in terms of, first of all, I see in your question, Anuroop, there are two parts. Let's say first part is like pure unsecured lending comparing to other type of lendings, like first of all secured, like, and second also accept unsecured vice other type of lending. Also, second part is what's the difference for fintech companies should be taken into account regulation, right? And for like classic or classic bank, right? Let's start with unsecured. Unsecured overall is just pure based on approach of not only regulators but lenders by themselves. Of course, is initially more risky, let's say, lending, yeah, and it should be somehow cautiously managed. And here is usually two parts, yeah. Also from regulator can somehow, let's say, make some constraints, cap on it, or players by themselves. Here, I think what is coming to my mind first is my experience for Vietnam, for example, how central bank, which is called State Bank of Vietnam, look at it. It's just as an example, right? So they believe that, or their direction is that unsecured lending is should be minimized as much as possible. And the logic is like people, especially let's say Asian people, especially not very educated or less financial with low financial literacy, they cannot manage well their financials. And if you allow them to have like ability to get like unsecured loans, they can spend it, they can use it for non like right purposes like betting, gaming, all that stuff. Yeah, and their logic is pretty straightforward. So unsecured lending should be not maybe minimized but kept somehow. And the way they're regulating there for banks and for they started regulating for financing companies also, they're starting to they introduce some step-by-step caps in portfolios. The share of unsecured loans in portfolio could not be higher than. It's like step-by-step they're decreasing it. Here is also on my mind personally, here is some trick also, which is also used by players. They're just starting actively switching to credit cards. And with the logic of central bank, like unsecured lending is like not good things, but they still not like looking the same way to credit cards. And it's just mostly what players are trying to do. They're shifting from unsecured to credit cards, right? So here is, I mean, not related to pure fintech activity, should be taken into account also, and it should be regulated somehow. Maybe it could be some additional requirements with applied here. I'm not voting for it for sure, but just some as an example, right? What I mentioned. Second part, which is what is specific, and here is much more interesting things on my mind. What is happening now? What is happening last few years and changing pretty rapidly is specific on fintech and making business online, right? So what are brick and mortar banks? What are the main differences comparing to online lending? Is actually no offline, means like no branches, means specific requirements for KYC, right? Usually, so banks are not seeing their clients, and fintech companies are operating without personal contact. Second is not not direct ownership on infrastructure, but it's just specific. It's like if market is, let's say, infrastructure is pretty developed, it's already just you can outsource it, right? You don't have your own branches, your own ATM machines. You don't have your even you are not issuing your own cards. So, but this infrastructure, if it's developed in the market, it could be used or outsourced, let's say. Yeah, like. Another this is the main difference. That is the main difference, and also it means it's the source of not much but more risks in terms of identification of client, right, and cybersecurity of storing the data, of keeping the data, and protecting it, which led to also some specific and regulation should be somehow taken into account, right? That if I can say regulation is a place for India, based on my current understanding, maybe not long term of experience yet, but mostly regulation for banks, for non-banking finance companies are in place. My idea here, what I'm trying to describe is that it should be somehow adopted, and it should be taken into account how it should be applied for pure online lending, right? If you have some, let's say, fair practice code, which is in place, right? It should be maybe specifically focused on on not focused, should be rethinking about how to apply it for fintech companies. Let me get some example. Yeah. So we have, for example, it was some wave of negative PR in India, yeah, recently. Such cases happen in other markets also, and I saw it in Vietnam as an example. I saw it in Indonesia. It was happened also in Philippines, but what currently how it works, yeah. Take into account here is both parts are important. That let me just short remark because of impact of regulation and how they're affecting what the regulator is saying, how it's let's say translated by PR guys, by journalists, and what are understanding by clients. Another important point that clients are of fintech companies target audience, and naturally clients usually a much bigger base, right? Because still banks and non-banking finance companies still covering mostly, let's say, near prime and upper segment, or mass and higher. And clients of fintech is much wider, starting from subprime. And it's also should be taken into account with all movements. And what I saw in few markets, like if some reasonable actions started by regulator or by journalist, but effect could be different. For example, yeah, how it was more or less similar to India on my mind. If okay, let me just focus again on Vietnam case. It was like defined after some articles, after some investigations, some simple things that to differentiate, to split between, let's say, good players and bad players. It was defined that, okay, those who are making business through mobile application and some other aspects also we're using, they are mostly, many of them are not fair players, right? And others are fair. But how it was like understood by journalists and by, most important, by most of population, they just fixed that if player has mobile app, most probably is bad player. And you know, and it was more affected, I believe, also a lot of many good players in India also. And in Vietnam it was like this: if you have mobile app, you are bad. If you don't have, okay. And so it was really funny situation. Even some players have, like, for example, web and making less fair play, but without mobile app, nobody like touch them. Like, but if even good players, or even, you know, those who are working with banks, with finance companies, they had mobile app, initially people starting to treat that they're bad. So it's, I think it's really fair example that it's what I'm trying to say here, that it should be more cautious, yeah, analyzing and actions done in regulation also, in like, because it could be easily affected if people, most of people just treated because of their low financial literacy, because people prefer some simple things to understand, right? They just understand, okay, mobile app is bad, no, mobile app is good. And it was clear example in a few markets what I saw. So here is also what I'm trying to say, that regulation should be not resynced, but should be carefully applied to fintech players. And I believe it could be done step by step, and like with making more minor steps, and see how it's affected the market. Because finally, as we all understand, like demand are there. Fintech definitely have not only some partially, maybe not fair practice, some of them, but definitely here is, especially taking into account our limitations during our current COVID times, they definitely have advantages that allow people not to move, yeah, not to contact to many other people, to apply, to get some decision, and to get finally services or products online. Definitely there are pluses, right?
Okay, so Artem, 2 points. What I think, audiences, I'm just summarizing what I've understood for the benefit of others. One, you believe that, the digital market space should be regulated, but in a manner that it's not like too many regulations strangling the digital finance space and not allowing it to grow. It should be more like a grandfathering effect, which is already there in the way RBI builds its regulations. Slowly and steadily, it will give you a timeline of a 2 years or 3 years to comply with regulations in X+1, X+2, X+3 steps. This is one, what I could understand. Number two, what I could understand is, again, India and Vietnam market may not be completely similar, but there is an inherent perception bias when it comes to the lending segment. If you are not meeting a person who knows you are getting the right money or not, you are not able to, if you are as you rightly said, in Vietnam, if you are an application on the phone, it's a bad thing. But if it's not an application on the phone, but doing the same thing, maybe it is a good thing. So what I understand from your answer is, slowly and steadily, with the benefit of the regulator, as well as the media and PR agencies across the world, what you have experienced is, slowly and steadily, a better perception has been created. Whereas in an Asian market or in an Indian market, there is inherent perception bias against digital lending, which needs to be better over a period of time by giving more financial literacy and educating people around how safe, how reliable, and how secured are digital lenders as well in the market. Did I get you correctly?
Yes, yes, absolutely. It's actually, it's like in pure, let's say, portfolio management in lending, like, and especially unsecured. You are like making, you are not scaling any changes, product or risk changes or criteria, like risk decisions, like immediately for the whole portfolio, for the whole volumes. You are making some step, see the results, also maybe just how it's the perception of it, what's the consequence of the step, and also just make it more cautious, not to have like totally different effect or feasibly different that you are expected to be. And step by step, with education, with not clear, with trying to show, well, this is one criteria, to define black and white, which should be perceived differently. Yeah.
Perfect. Thank you, Artem. So now, because we'll not be having a lot of time, so given the paucity of time, I'll quickly move to Milan. I have known him for a couple of years. I have seen him doing wonderful work, taking home credit to new heights in India. So Milan, the question for you is there a difference between operating in the Indian market vis-a-vis more mature markets, which again, Artem pointed out about the financial literacy and stuff like that, markets such as Europe, considering the difference between education levels and general awareness? Do you think the regulator will take or has been taking a very protectionist view because of these factors, because the financial literacy is low in India? So Milan, if you could answer that.
Okay, thank you. Hello, everybody. Artem actually mentioned it, right? But I think the literacy, and if you take that on all levels, actually is making the differentiation for the subprime segment. In the prime segment and upper prime segment, I think the lending in India is quite comparable to the other countries. But the subprime segment specifics of the size of the country, basically, and are making a difference. So if you start basically from looking on the education level of the people who are trying to take the loans, and the languages which they are using is already becoming much more difficult for the lender to be transparent actually to all the customers, right? Because the number of the languages in India is obviously making it different. You can hardly look for, actually, I think, another market which has so many languages like Indian market. And to be able to explain the customer properly what actually services are offered and under which conditions is becoming tricky only just due to the languages. The second challenge is the digital part, and there, if you look, actually a lot of users, especially in the subprime segment, are digital savvy from the sense that they can operate the smartphone. They do that well, and they do it on a daily basis. But they use only the selected services, and they do use only the selected use cases. So they are ordering their food, they do some selective shopping in the stores which they trust, and they use mainly social media like WhatsApp, Facebook, and YouTube, right? And since mobile phones are one of the major consumers of the network in India, they are not venturing, actually, sadly enough, to the other parts of the digital space, and they are not getting educated about how to treat actually something more serious like the credit applications and and even the government websites. And we can see it, right? A lot of people actually cannot even operate the Aadhaar website, and that's built by government of India. So I think that's what is definitely making the market different, that you have to adhere actually to the specific user experience for those niche segments, and there is a lot of them, and they are actually big. So if you compare it to the Europe, those niche segments are of the size of the small countries in Europe or bigger, right? So they make a difference on the market. And I think that's actually those three things are the biggest differentiators. And besides of that, actually the financial literacy is the last one, which is making a big difference. A lot of people don't know actually what does it mean to lend from the lender, right? They are typically having experience with lending at home from their family circle or from some loan shark, but they don't understand that repayment on every fifth means that on every fifth the money should be on the account, and not that they will start negotiating basically the day of repayment. So I think that all the subprime lenders are going basically through this, and they are educating the market to get basically people to understand what commitments they are doing actually.
Thanks, Milan. So I think I understand the symmetry in the lines that Artem spoke and you spoke. So I think the experiences, both of you have had similar, because you have been working in India. Artem has been looking into Vietnam and India, and both of you, hail from Europe. So the market that you have seen as a structure or the acceptance, I think, again, you are emphasizing on the point that it has to be a constant effort of financial literacy that either the players or the regulator should bring in place because of the segment that, the digital lending space caters to. Okay. Yeah. So now quickly moving to Ilica. So Ilica, I think, you have seen, PC Financial growing and scaling up very fast in India. So, but still, I think there is a huge vacuum when it comes to, digital lending as an acceptance in the minds of Indians. So in relation to that, a quick question for you, Ilica. On a global scale, do you think India is fulfilling its potential in the digital lending space? What are the steps it can take for more financial inclusion? What are some of the best practices you have seen globally?
Okay. Hi, Anuroop. Hi, good evening, everyone. So your question has three parts regarding whether India is fulfilling its potential in the digital lending space. I will say digital lending started in India majorly in 2015. And since then, continuously, it's trying to get in a better position in the global digital lending landscape. This is just a starting phase, and we have a long way to go to include all population in formal banking system. For instance, I'll quote some data points from some reports and some personal analysis also, which we have done in our company. For instance, as per Economist 2019 data on financial inclusion, it says that overall environment for financial inclusion has improved globally, with India having the most favorable condition for inclusive finance. So thanks to government and the regulators for various tech stacks and innovations in regulatory technologies that has helped in making the environment conducive for financial inclusion. Be it Aadhaar in 2009, then linking it with Jandhan and mobile, eKYC, e-sign, digital locker, and some prime the case studies for the world, UPI and video KYC, which was recently launched by RBI. So my point is, our tech stack is ready. We have, the conducive environment. But yes, coming on to the point, whether we have reached or not, I think we are yet to reach its full potential. And we still have some, distance to cover in financial inclusion. For instance, there was a data point before COVID in 2018 by BIS, which said that India was ranked the last as per the per capita penetration and frequency of use, with just 18 digital transactions per person per year, which is half of Mexico and Saudi Arabia, and maybe 1/8 of China, 1/25 of, I think it was US, and 1/45 of Singapore. So we are ready, but we have to, we have long way to go. And there are many challenges, especially like Artem and Milan pointed out on digital literacy. This is exactly my point also, that we have seen with our customers that we are catering to in PC Financial, because this is digital finance literacy is kind of interlinked with financial inclusion. India, as per the World Bank report, has the most inactive bank accounts in the world. And as per one more study, only 24% adults in India are financially literate. So it is all about 2 points. One is digital literacy and one is financial literacy. So if suppose there are people who are financially literate, they are sometimes not digitally literate. Then they fall prey to digital scams and cyber crimes. So all these things lead to the loss of trust and confidence, especially in rural areas, because 65% of Indians' population reside in rural area. So yes, like Artem and Milan, I also believe that we need something around digital literacy and financial literacy initiatives, and particularly in rural area. Apart from this, I have experience, I would like to point out one more area where we could, improve, which is we need more investment in technology, especially in terms of planning the bandwidth and upgrading the infrastructure. For instance, in our digital lending journey, we need to do full KYC of customers. We use CKYC, we use VCIP, where Aadhaar-based XML-based authentication is required for full compliance. So without completing full KYC, I cannot disburse loans. Like Milan pointed out about Aadhaar website. Similarly, there, the people are not able to use the website because they don't have access to the where I left. Am I audible now?
Yes. Yes.
You are audible.
Okay. Okay. So, my point here was like Milan pointed out on the customers are not able to even go on Aadhaar and download XML. Similarly, there are some issues in UIDI portal. It hampers the customer loan journey overall because they are not able to complete my XML. And they even do not wait for VKYC to get completed, which eventually leads to dropping off of my loan applications. Similarly, in CKYC, we have limited database there, and it does not match the speed like fintech lenders do. So this was, the challenges that we have particularly seen in our space. Linking to digital lending, I'll also go to digital payments, which is very important for us for our repayments and disbursements. So most of our customers, they belong to, tier 2, tier 3 regions with or rural regions. They have bank accounts in cooperative banks, PSU banks, or smaller universal banks. They have legacy system and they still do manual reconciliation. Their, infrastructure capacity planning, it's not meeting the demand of the customers. Their customers, like I think Artem also pointed out, their customers are, the regional customers are there online. They are transacting, but they have not anticipated those needs and have not taken account that infrastructure. So what happens is eventually transactions fail, we cannot do disbursements, repayments get failed, payments get lost somewhere, and we are chasing all the different stakeholders. So basically after literacy point, this is another challenge where the customers lose trust and the confidence, and it impacts our lending also. So what we need is we need a comprehensive planning and discussion, including all the stakeholders in this entire digital lending journey that are involved, so that we can solve these practical issues. My last, the point here, the challenge that we have particularly not seen, but I have observed in other areas also, like absence of low-cost financial products in the rural masses, especially because I am focusing more on rural and tier 2, tier 3 regions, because that's where my financial inclusion will come from. A very important point is, for instance, lack of local knowledge. There is no many products available in the financial services space who have included the local regional languages, which again discourages the customers. In this space, small finance banks are doing good. They have the reach. They have focus on and investments in technology also, but they are limited in number. They are, I think, hardly 10. Then we have regional banks, but I'm not sure about their technology capabilities. So it's important that more private participation is there, but also with increased investments in regulatory supervision bodies, so that we can have a balanced regulated financial inclusion growth. So these are the certain challenges and some suggestions, high level suggestions for the regulators and the government to include from the practical point of view. And yes, definitely, because this is a learning for us. We are in the very nascent phase of our digital lending. So we should take learnings, best practices from all the countries, whether it's developing or developed. Looking at controversies, particularly the digital lending industry has faced in 2020 and facing now also in 21. I think we can take inspiration from China, Europe, like China and UK. They have put clear and explicit guidelines on what fees and charges such fintech lenders can charge. And I think from EU, we can learn about the great GDPR regulation that is very noteworthy and inspirational for consumer protection and privacy. So these are my key points that I have for this.
It is extremely actually, interesting to hear all three of you, because I was expecting a very contrary answer. No one wants to get regulated. Like, I being a lawyer, I would never want to be regulated. So we want everything as a free market. But I'm realizing person sitting out of Vietnam, somebody from home credit, all of you are actually pro-regulation. So you want this market to be regulated. So I think I had another question for you, which was relating to, because the disrepute last year, because of that fiasco that happened in the southern part of the country, and
Right.
all digital lending list was out in the public, police started arresting people, and all that happened without proper research and analysis of what had happened, without differentiating between a fintech player and a proper NBFC which is licensed by RBI. And I was wondering, what would be your take? How should it be regulated? But I think you answered it already, that you believe that the story from Europe should be taken into place, the story from China should be taken into place, and it should be regulated. And adding on to what Artem said, it should not be regulated heavily at one go, but it should be in a phased manner, so that the private players allows them to grow within that specified time. Okay, so now that was a wonderful answer, Ilica. Now moving on to Milan quickly. So Milan, you have been in India for some time now. You have worked in Europe. So what are some of the peculiarities that you have felt in the Indian market as compared to others? And what changes has your business, your group seen in the last 5 years? And maybe, you would have also partially seen a time when Geo came up with saying that internet is absolutely free and digital lending cannot run without internet. So in the times of cheaper internet, what is the transition that you have seen in the last 5 years, Milan?
Okay, well, I think the most obvious one is the accessibility of the information and the internet, and you see it. Home credit is being part of it, basically, to transferring from the key phones to the smartphones, and we see that transition happening mainly due actually the support of the telco operators, right? They obviously they are driven by their P&L, and getting actually some income from the data. But it brings to the people basically much more than just the new phone. It brings them the access basically to the to the information, and we saw it especially with the last COVID wave, actually the previous one. And it's horrible to say last one. That means that some other one probably coming. But people stop caring about the cameras for the selfies, and they start caring actually how good the phones are for the education of their kids. So they start caring if the phones are big enough for homeschooling, if they are actually good enough for having the video conference with the employer and so on. And through that, you see actually a huge movement. I mean, 5 years ago, there was more than half of the population probably didn't have a smartphones. Now we are on much lesser numbers, and that's a huge shift. I think as well you see basically a shift of the people coming to the bigger cities, and that's again supporting basically the digitalization of all the other services. So I think the biggest shift is basically the digitalization, which was obviously supported by COVID. But besides of that, the access to the information and the price of the data of the internet access actually in India is fairly low compared to the Europe and US. So I think that is helping. Obviously, Geo had a big play in it to changing the market forever, I think, in the telco. But in every state or every market, it's somebody who is driving that, right? So in Europe, it was driven by O2 mainly, and I think in US it was mainly driven by Apple, basically. But it's happening everywhere, and I think it's bringing the access to as well a lot of potential fraud. because as Ilica mentioned, the fraud in online, I think, is a little bit more articulated than the fraud in the offline world, and it's better hidden. So I think that is the space for the regulators, especially to help actually to people to be protected of the fraud, not necessarily the entities which are actually lending the money. So I think that's the biggest change actually. Besides of that, obviously the regulation for the banks, for NBFCs are changing as well. We see it and we feel it. Sometimes maybe actually those regulations are moving in all different directions, so it will be good to probably guide them through the digital space with help of the NBFCs and with help of the fintechs, because I do feel that if you regulate only one part of the market, then you push that market out, and then obviously the unregulated part will grow and create another issues. So I think the balancing the regulation will be the big task for the government.
Okay. Yeah. So I hope, Geo does not take you and me seriously, deciding to get into the digital lending space with enormous data they're having in their store because of giving free Geo internet for a very long period of time. So, because of the paucity of time, just a common question for all the panelists here. To begin with, Artem, what is one thing that you think India can learn and benefit from other jurisdictions or international markets in the digital lending space? And the same question will stand for Milan and Ilica. Once Artem is done, Milan and Ilica can put forward their answers. So Artem, what's your answer for this?
Yes, thank you, Anuroop. Here is, I believe here is maybe my reference will be to out of countries I pretty well know is to Russia, and I believe there could be a couple of things. I really believe, first, like you mentioned, right, that you expected or not expect that maybe there is no case that we represent different type of players, more or less, we can say, right, and there is no idea of not to be regulated. Actually, it's absolutely true, and it's like in all area, if in any area, right, if it's growing fintech. Right, there are always different players. Some of them are just very short-term player to get some very fast benefits and without any strategic planning to work on the market and to grow some brand and to grow some business which is transparent and reliable and interesting for partnership, for investors, all the stuff, right? But those who are playing, who look at market strategically and planning to work on the market for a long time, for feasible time as minimum, they're really interested in regulating in terms of clearly differentiating between, let's say, fair players and those who are not fair. And it's a really important part, I believe, that's the case, right? And we, if you can say we are really interested to like in clarification, and it's also related to financial literacy, related to dialogue with regulators to define some criteria, but as I mentioned, maybe step by step to differentiate those who are making it fair practice and those who are not. I'm coming back from that point and trying to make the bridge to this experience in Russia, for example, when microfinance companies, which are also regulated by central bank, like banks in Russia, it was a practice, on my mind, pretty interesting, and the role of self-regulation. What I'm trying to say here, if it will be more or less clear and main or like relatively market makers starting to organize, there is already association, as I know, right? But it somehow this entity could help a lot, and it's really could be interesting, like win-win situation for players, for that players, and for regulator also. And it could be somehow a buffer of adoption, all regulation to, let's say, to the market from one side, and also it could be some support, some case related to all. One of the main issue of it's not only fintech, but let's say players working with a lot of huge share of population, especially with low income, low financial literacy. It's all about collection, of course, right? And one of the case from the Russia also, if it will be, and it could be reasonable for that players, if all complaints will go not directly to RBI, for example, if it will be the case, because it depends on, I can say depends on specific mentality, maybe some habits of the country, of population. Because when I initiated somehow, not initiated, we discussed it for Vietnam, mainly I still believe in it, but mainly it was said to me like mostly in Vietnam it will not work, because usually people just don't trust any associations, they just prefer to make complaint directly to a central bank, right? And it works in Russia. It could be really interesting as an idea that complaints will be managed by this self-regulation, because it's actually is interest of main participants, right? And they will be first level of analyzing of complaint, see is it reasonable or not, to understand who is the source of complaint, and already made some actions not involving RBI or like making pre-selection, and already acting on this level, which could lead market to right direction initially, right? Such point what I'm what I want to highlight here. So
Thank
it's
you.
I believe it's self-regulation could be, and all other, I think other things I think I could mostly repeat what I said already, and I believe it could be done in that term.
Okay. So Ilica, what's your take on this?
Though I also have, I have raised those points, but and I won't take much time, but I'll just summarize those points that I have. Again, from I'll take this liberty. Instead of one thing, I'll share two things. One is from the business point of view, and one is from consumers' point of view. And I hope, working committee group of RBI, which is working on digital lending, new guidelines. I hope these points are also covered in future in those guidelines. Because they have to understand that, lately digital lending players, they have been in news for the charges and the fees they have been charging. This is a sort of gray area where regulations are mum and it's quite subjective. And digital lender players like us, we play in entire unsecured, area. And so the best, the case study or the best practices that we can adopt is UK's, the FCA has come out, they have termed these short-term players as high-cost short-term credit players, where the payday loans and short-term installment loans are, are categorized, where they have also capped the annual percentage return, the default charges, and the interest rates. So I hope something on the similar lines could be done for the players who are into the unsecured personal lending space. So this is one good, case study that we can, benefit from. From consumers' point of view, like I highlighted, this is all about European Union's GDPR, which India has also adopted, which is DPB, which is still in discussion stage. I hope it's implemented and audited well in future. So these are the 2 points that I look forward that we can benefit from.
Milan, what's your take?
For me, I look on the regulation as on a service. So for me, actually, it should be designed for the user, not for the regulator. And if you look on it that way, then I think there are some gaps to be filled in. If you look on the digital KYC, if you look on actually sharing of the information in India and so on, there are better examples, let's say, in the world how to do that. If you take in KYC example of Hong Kong, in sharing of the data, you can take the open banking concept of Europe. And those are designed, let's say, with the framework of having the user in front of that. And they are actually supporting the easy of the use. And sometimes I feel like some of the regulations are done for the, let's say, with the good heart and meant well for the user, but the user is not kept in mind basically to understand actually how to deal with that regulation. So I think maybe some inspiration in that area will be good for the regulators to take.
Okay. Thank you everybody for your time, and we have anyway overstretched beyond some few minutes, and I think there is so much knowledge to take back, and we at AKP would be anyway pulling up a document based on what all inputs that you guys have given, putting it on web, and also maybe sending a copy to the RBI because they were expected to come with the report this month, but they have yet not come up with the report. But I hope, they would consider what you guys, being players, having seen the international market, what you believe should be done for this market to grow and in a fair way to grow rather. So thank you everybody for your time, and the next panel discussion will be moderated by my colleague Kritika, which will start in next 5 minutes. So we have a short break for the attendees and the panelists to grab a cup of coffee or tea. Thank you, everybody.
Thank you.
Thank you.
Thank you.